If you are a senior over 60, a green card holder, a naturalized citizen, or any immigrant who files taxes in the United States, there is a brand new IRS filing rule taking effect in 2026 that you absolutely need to understand now. Ignoring or misunderstanding this rule could cost you thousands of dollars in penalties, trigger an IRS audit, and in some situations even create problems for your immigration status. My name is Timothy. I've been a senior U.S. immigration professional for 6 years, and through U.S. Updates Hub, I've made it my mission to help seniors and immigrants avoid tax and immigration surprises that can turn their lives upside down. Stay with me until the very end, because what I explain today can save you from penalties, protect your benefits, and help keep your financial future in America secure. Let me speak directly to you for a moment. I know tax season is already stressful. You work hard, you pay what you owe, you try to follow the rules, and the last thing you want is to discover the IRS changed something without you realizing it. For many immigrants, taxes add another layer of pressure because you know your tax history can affect your green card, your citizenship application, and even your ability to sponsor family members. You understand that one mistake, one missed form, one question answered incorrectly can create complications that ripple through your entire immigration journey. You've already navigated so much complexity just to build your life here, and the idea of new tax rules adding more obstacles can feel overwhelming. For seniors, especially those who've spent years or even decades living abroad, working internationally, or maintaining ties to your country of origin, the U.S. tax system can seem like it was designed to confuse you. You might receive a pension from the country where you worked for 30 years. You might have a modest savings account overseas that you've kept for emergencies or to help family members. You might own a small piece of property where you were born. And until now, you may not have realized that all of these things create U.S. tax reporting obligations. So when you hear there is a new IRS filing rule aimed specifically at seniors and immigrants, it's natural to feel worried. It's natural to wonder if you've been doing something wrong all along. It's natural to fear what might happen if the government thinks you've been hiding something, even though you haven't been hiding anything at all. But I want you to hear this clearly. Today is not about fear. It's about preparation. This new rule is coming, and you can't stop that. But if you understand it and follow the steps I'm going to share, you will be fine. More than fine, actually. You'll be protected. You'll have peace of mind. And you'll be able to move forward with confidence knowing that you're doing everything right. Take a deep breath. You're in the right place, and we're going to walk through this together. By the end of this video, you'll know exactly what's changing, why it's changing, who it affects, and most importantly, what you need to do right now to stay compliant and protect yourself. As of now, the Internal Revenue Service has officially finalized a new filing rule that will apply starting with the 2026 tax year, meaning returns you file in early 2027. This isn't a rumor. This isn't speculation. This is official policy that has been published and is now being implemented. The rule was first proposed in late 2024 as part of a broader IRS effort to increase compliance with foreign account reporting, improve data sharing with other federal agencies, including USCIS and the Social Security Administration, and close what the Treasury Department has called the Senior and Immigrant Compliance Gap. What does that mean? Essentially, the government has identified that seniors and immigrants as groups are less likely than other taxpayers to report foreign financial accounts and foreign income. In most cases, this isn't because people are trying to cheat the system. It's because they simply don't know the rules. They don't realize that the U.S. taxes worldwide income. They don't understand that a pension from their home country or a bank account they've had since childhood must be reported to the IRS. The government wants to change that, and rather than rely on people discovering these rules on their own, they're building the questions and reporting requirements directly into the standard tax forms that everyone has to file. These changes have been covered by major outlets like the Wall Street Journal, Reuters, and the Associated Press. The full text appears on the IRS website in Notice 2025-XX and in the updated instructions for Forms 1040, 8938, and the FBAR. If you want to verify what I'm telling you, you can look up these documents yourself. Everything I'm sharing is based on official government sources. Dakshaksur, what the new rule means in plain language. Here is what the new rule means in plain language without all the legal jargon and technical terms that make IRS documents so hard to understand. Starting with the 2026 tax year, all taxpayers who are 60 or older and all taxpayers who are not U.S. citizens by birth, meaning green card holders, naturalized citizens, and certain visa holders who file U.S. tax returns, will have to answer an expanded set of questions on their Form 1040 about foreign financial accounts, foreign pensions, foreign Social Security type benefits, international money transfers in the past year, ownership interests in foreign businesses or property. Many of these questions were optional in the past or appeared only on specialized forms that most people never filled out. Under the new rule, they become mandatory on the standard Form 1040, the basic tax return that almost every taxpayer files. You won't be able to skip them. You won't be able to leave them blank. The form will require you to answer yes or no, and if you answer yes, you'll need to provide details. On top of that, the reporting thresholds for foreign financial assets under Form 8938, Statement of Specified Foreign Financial Assets, are being lowered significantly for these groups. Let me explain what Form 8938 is. It's a form that the IRS created to get information about your foreign financial assets. It's different from the FBAR, which I'll explain in a moment. Form 8938 is filed with your regular tax return and asks for detailed information about foreign bank accounts, foreign stocks and securities, foreign partnership interests, and other foreign financial assets. Previously, single filers living in the U.S. had to file Form 8938 if their foreign assets were over $50,000 at year-end or $75,000 at any point during the year. For married couples filing jointly, the thresholds were even higher, $100,000 at year-end or $150,000 at any time during the year. Under the new rule for seniors over 60 and for all immigrant filers, regardless of age, those thresholds dropped to $25,000 at year-end and $40,000 at any point during the year. For married couples in these categories filing jointly, the thresholds dropped to $50,000 at year-end and $80,000 at any point during the year. In practice, that means if you have a bank account, pension, investment, or property interest in another country worth more than $25,000 at the end of the year, or more than $40,000 at any time during the year, you will have to report it on Form 8938, even if you were below the threshold in the past and never had to file this form before. This is a significant change. Many people who have been filing their taxes correctly for years, people who have never had to worry about Form 8938, will now need to file it. Now, let me explain the FBAR because this confuses a lot of people, and understanding the difference is critical. The FBAR, Foreign Bank Account Report, is still separate from your tax return and is filed electronically with FinCEN, the Financial Crimes Enforcement Network, which is part of the U.S. Treasury Department. Its threshold is unchanged. If the total value of your foreign accounts exceeds $10,000 at any point during the year, you must file an FBAR. Notice I said the total value of all your accounts combined. So if you have 3 foreign bank accounts, one with $4,000, one with $3,500, and one with $3,000, the total is $10,500, and you must file an FBAR even though no single account is over $10,000. The FBAR deadline is April 15th, the same as your tax return, but it has an automatic extension to October 15th. You don't have to request the extension. It's automatic. So to be clear, Form 8938 and the FBAR are two different things. They have different thresholds, different filing locations, and different purposes. Many people will need to file both. Some will need to file only one. Some will not need to file either. But you need to understand the requirements for both. Here's where the new rule gets really important. The new IRS rule creates automatic cross-checking between your answers on Form 1040, your Form 8938 if you file it, and your FBAR records. If there is any mismatch, for example, you say yes on Form 1040 to having foreign accounts but do not file an FBAR, or the amounts you report don't line up, the IRS system will automatically generate a notice and may refer your case for audit. This is not a manual process. where someone at the IRS might or might not notice the discrepancy. This is an automated system that will flag inconsistencies every single time. I know some of you might be asking, why are seniors and immigrants being singled out? Is this fair? The IRS has publicly said these two groups account for a large amount of unintentional non-compliance in foreign account reporting. Let me stress that word, unintentional. The government is not saying that seniors and immigrants are criminals or tax cheats. They're saying these groups are more likely to have foreign financial ties and less likely to know about the reporting requirements. Many seniors who retired abroad or who receive pensions from their home countries simply don't know those accounts, and payments must be reported. They worked in another country for 20, 30, 40 years. They earned a pension. They're now living in the U.S., receiving that pension, and they think of it as retirement income, not as foreign income that needs special reporting. Many immigrants keep bank accounts, property, or investments in their country of origin and are unaware that the U.S. taxes worldwide income. They might think, this is money I earned before I came to the U.S., or this is just a small account I keep to help my parents, or I already paid taxes on this in my home country, so I don't need to report it here. But that's not how U.S. tax law works. The United States is one of only a few countries in the world that taxes its citizens and residents on their worldwide income, no matter where that income is earned. If you are a U.S. tax resident, which includes green card holders and people who meet the substantial presence test, you must report all of your income from everywhere in the world. The new rule is meant to close this gap by making the questions impossible to overlook and creating automatic enforcement triggers when answers and records don't line up. Now, let's look at what this means for different groups, because the implications are slightly different depending on your status. You will have to answer the new questions on your 1040 accurately. If you receive any pension, Social Security, or similar government benefit from another country, you must report it as income on your U.S. tax return. If you have bank accounts overseas, even small or rarely used accounts, even accounts that have been sitting there with almost no activity for years, you must disclose them. Because of the lower thresholds, many seniors who never had to file Form 8938 before will now have to. If you worked abroad, if you retired in another country, and then returned to the U.S., if you maintain any financial presence outside the United States, these new rules apply to you. The stakes are even higher. Your tax compliance history is already something USCIS can look at when you apply for citizenship. Tax compliance is considered part of good moral character, one of the requirements for naturalization. Under the new data sharing arrangements tied to this rule, USCIS will receive automatic flags if you skip the foreign account questions, you fail to file a required FBAR or Form 8938, or the information you report doesn't match FBAR records. This does not automatically mean your citizenship will be denied, but it does mean any inconsistency is more likely to lead to extra questioning, document requests, and delays during your naturalization process. If you're planning to apply for citizenship in the next few years, getting your tax filings in perfect order now is not just a good idea, it's essential. If you are a naturalized U.S. citizen, you have the same basic tax obligations as any other citizen. Once you become a U.S. citizen, you have all the same rights and all the same responsibilities as someone who was born here. But because you were not a citizen at birth, the new mandatory questions will still apply to you based on the IRS's view that naturalized citizens are statistically more likely to have continuing financial ties overseas. This might feel unfair. You might think, I'm a citizen now. Why am I being treated differently? The answer is that you're not being treated differently in terms of your tax obligations. You have the same obligations as everyone else. But the IRS is making the questions mandatory for you because they have identified that naturalized citizens as a group are more likely to have foreign accounts and less likely to know they need to report them. This includes H-1B, L-1, O-1, and other work visas, as well as some treaty residents. You must follow the new rules if you meet the U.S. tax residency tests. Not complying could have consequences when you try to renew your visa or apply for a green card, especially if non-compliance is seen as willful or repeated. Immigration officers are increasingly looking at tax compliance as part of the overall evaluation of whether someone is following U.S. laws and should be allowed to remain in or adjust their status in the United States. So, what should you do right now to protect yourself? Here are 5 specific steps you can take today, this week, this month, to make sure you're ready when the new rules take effect. Step 1. Collect full information about every financial account, investment, pension, or property you hold outside the United States. This is the foundation of everything else. You cannot comply with rules you don't understand, and you cannot report assets you haven't identified. Sit down with a pen and paper or open a spreadsheet and make a complete list. Include bank accounts, even with low or zero balances, retirement and pension accounts, life insurance policies with cash value, investment accounts and portfolios, real estate ownership, even partial ownership, foreign businesses or partnership interests, any other financial asset located outside the United States. For each item on your list, note the institution name, the country where it's located, the account or reference number, and the highest value during the year. Why the highest value? Because for FBAR purposes, you need to report the maximum value at any point during the year, not just the year-end balance. This step might take some time, especially if you have accounts in multiple countries or if you haven't kept good records. But it's absolutely essential. You cannot fill out the forms correctly without this information. Step 2. Figure out whether you need to file an FBAR for the current year. Remember, you must file an FBAR if the total value of all your foreign accounts together exceeded $10,000 at any time in the year. Use the list you created in Step 1. Add up the maximum values of all your foreign accounts. If the total is over $10,000, you need to file an FBAR. The FBAR is due April 15th with an automatic extension to October 15th. It's filed electronically through the FinCEN website using a system called the BSA e-filing system. If you realize you should have been filing FBARs in past years and didn't, don't panic, but don't ignore it either. Talk to a tax professional about the IRS streamlined filing compliance procedures, which may let you catch up with reduced penalties if your non-compliance was non-willful. The streamlined procedures are designed for exactly this situation. People who didn't know they had to file, not people who were intentionally hiding assets. If you qualify, you can file the last 6 years of delinquent FBARs and amend the last 3 years of tax returns, and the penalties are much lower than they would be if the IRS discovers the problem first. Step 3. Review the new Form 8938 thresholds and decide whether you'll be required to file it for the 2026 tax year. If you expect your foreign assets to exceed $25,000 at year-end or $40,000 at any point in the year, start gathering documents now. Form 8938 is more detailed than the FBAR. It asks for specific information about each foreign account and asset, including the type of asset, the issuer or counterparty, the maximum value during the year, and whether the asset produced any income. If you have investments, you'll need statements showing the value at different points during the year. If you have a foreign pension, you'll need documentation of its value. If you own foreign real estate, you may need a professional appraisal. Gathering all of this information takes time. Don't wait until April 2027 when your taxes are due. Start now. Step 4. If you receive any pension, Social Security, or government benefit from another country, make sure you're reporting it correctly on your U.S. return. This is an area where many people make mistakes, often without realizing it. If you receive a pension from another country, it is generally taxable in the United States. Many countries have tax treaties with the U.S. that affect how that income is taxed. In some cases, you may be able to claim credits or exclusions so you aren't taxed twice, but you must report the income first. You can't just decide not to report it because you think it might be covered by a treaty. A tax professional familiar with international issues can be very helpful here. They can look up the specific treaty provisions, calculate whether you're entitled to credits or exclusions, and make sure you're reporting everything correctly. Step 5. Keep copies of all your tax returns, FBAR filings, and Forms 8938 in a safe, organized place. This is especially important for green card holders and citizenship applicants. You may be asked to show these documents during a naturalization interview or other immigration process. Having everything organized and readily available will make that much easier and will show the immigration officer that you take your obligations seriously. I recommend keeping both paper copies and electronic copies. Scan everything and save it in a cloud storage service or on an external hard drive. That way, if something happens to your paper files, you still have access to everything. Let me give you a real-world example that shows why this matters and what can happen if you don't follow the rules, even unintentionally. I recently worked with a 68-year-old green card holder from India, Mrs. Patel. She has lived in the U.S. for 22 years, raised her children here, worked here, paid taxes here, and applied for citizenship last year. During her naturalization interview, the USCIS officer asked about foreign accounts. Mrs. Patel had a small bank account in India with around $15,000, money she kept for emergencies when visiting family. She had never filed FBARs because she didn't know she had to. She thought because the account was in her name from before she moved to the U.S. and because she had paid taxes on that money in India years ago, it didn't need to be reported. Under the old system, this might have slipped by. Many USCIS officers didn't ask detailed questions about foreign accounts, and there wasn't systematic cross-checking with IRS data. But because USCIS now cross-checks IRS and FBAR data more closely, the discrepancy was noticed. When Mrs. Patel said she had no foreign accounts during her interview, but FinCEN had no record of her filing FBARs, the officer knew something didn't add up. Her citizenship case was delayed about 8 months while she worked with a tax professional to file past FBARs going back 6 years and show that her failure to file earlier was non-willful. She had to gather bank statements from India going back multiple years. She had to write a detailed explanation. She had to pay the tax professional. She was eventually approved, but the stress, time, and cost were significant. She told me she cried when she got the delay notice because she was so worried her citizenship would be denied. Under the new 2026 rule, Mrs. Patel would have been asked clearly about foreign accounts on her Form 1040 every year and would have realized earlier that she needed to report them. The rule is stricter, but in some ways it also makes your obligations clearer if you pay attention and follow them. I also want to respond to a few common concerns I hear often from seniors and immigrants when I talk about these rules. What about my U.S. Social Security benefits? The new IRS rule does not change how U.S. Social Security is taxed. If you receive Social Security, up to 85% of your benefits can be taxable depending on your total income, just as before. What the rule does affect is foreign Social Security type benefits and foreign pensions. If you receive payments from another country's social insurance system, those payments are generally taxable in the U.S. unless a tax treaty says otherwise. The new mandatory questions on Form 1040 will ask specifically about these foreign benefits, so you must report them accurately. What if I don't have much money in my foreign accounts? Even if the amounts are small, you still need to report them if they exceed the thresholds. The FBAR threshold is $10,000 in total across all accounts. That's not a lot of money. You might think the government doesn't care about your $15,000 savings account, but the rules don't have exceptions for small amounts. If you meet the threshold, you must file. What if I already closed my foreign accounts? If you closed accounts during the year, you still need to report them if the total value exceeded the threshold at any point during that year. The FBAR instructions are very clear about this. You report all accounts that you had at any time during the year, even if they're closed by the time you file. The penalties for not complying. Another common question is about penalties for not complying. I want to be straight with you about this because the penalties can be very serious. Not filing an FBAR can result in penalties up to $10,000 per account per year for non-willful violations and up to the greater of $100,000 or 50% of the account balance for willful violations. Let me say that again. If the government determines that you willfully failed to file an FBAR, they can penalize you 50% of the account balance if you have $50,000 in a foreign account and you willfully didn't report it. The penalty could be $25,000, plus you still owe taxes on any income from that account. Not filing Form 8938 can lead to a $10,000 penalty, with additional penalties up to $50,000 if you continue not to file after the IRS notifies you. On top of fines, non-compliance can extend how long the IRS is allowed to audit you. Normally, the IRS has 3 years from when you file your return to audit you. But if you have unreported foreign income over a certain amount, that period extends to 6 years. And it can create real complications for immigration applications, especially if the government believes you were intentionally hiding information. Now, I don't want to scare you unnecessarily. Most people who make mistakes with foreign account reporting are not hit with huge penalties, especially if they come forward voluntarily and correct the problem. But you need to understand that the potential consequences are real and serious. This is not something to ignore or put off. As we wrap up, I want to emphasize something important. The goal of this new rule is not only to punish people, it's to make sure everyone follows the same rules and that the tax system is fair. Think about it from the government's perspective. They have one set of taxpayers who report everything, every dollar of income from every source, every foreign account, every foreign pension. And they have another set of taxpayers who, whether intentionally or unintentionally, don't report their foreign accounts and foreign income. That's not fair to the people who are following the rules, and it creates a gap in tax revenue that the government wants to close.